if your kids do plan on paying back their student loans,
Yeah, be
right?
great.
Always have them pay out of their account.
I
That way,
do.
if you need to remove that debt for whatever reason, then
Yeah,
you
I
have, as long as you show 12 months of payment history on those student loan debts, when it comes to a mortgage, they'll be able to back them out. But see, again, here's where a non-QM loan like a DSCR or, like I said, like a fix or flip,
it won't matter.
your ratios are irrelevant.
Hey, everybody, welcome to the Mike and Jake show. I'm Mike. We got Jake here. We got Lou Rose, mortgage broker. I'm losing my voice today. How you doing, Lou?
Good, good. How you guys doing?
Good. Very good.
Um,
Glad we have you here tonight.
yeah, appreciate it.
I'm sorry. I'm going to be talking a lot less. Jake's going to be hounding you with questions. He's always interested in this stuff, how we could get money. But so, Lou, let's go right into like how you got into becoming a mortgage broker, how you started it. Did you work at a bank first? What'd you
Yeah.
do?
No,
And how did you become a mortgage broker? And how long have you been doing it?
well, again, my name is Lou Rose. I'm with Homefront Mortgage. I've been doing mortgages for over 20 plus years. Quick story. I mean, I went to college, University of South Florida. Kind of graduated, started working like retail management. Hated it. Went to the like career center. Saw this ad about mortgages and owner finance paper. Really intrigued me. Interviewed with the guy, and he was from the University of South Florida. And at the time, I was living in Fort Lauderdale, so really liked the challenge. At first, I didn't understand what was going on. He explained it to me, and took the job. And he was like my mentor into the mortgage business. Because back in the '80s, when rates were through the roof,
Yeah, what were
remember
they
like
like
in the teens.
19% at that time?
Yeah, and so people would have all this equity, so they were basically the bank holding the paper. Let's say, I sell my house, to Jake for $250,000. I'm holding the note, charging you 6%. You're paying me, so it's just basically create a payment stream. So now I can sell that note at a discount, but I'm getting one lump sum with zero recourse. That if the loan defaults, so a lot of people they're like, hey, I got a $250,000 note. I don't, I'd rather have the lump sum instead of like maybe $1,500 a month. So they might sell that. I would basically review it just like a underwriter does, credit, assets, or credit, loan to value, all that stuff. So you may have like a $250,000 note. I can sit there and say, hey, I'll offer you $225,000 today. So you'll take a $25,000 loss. It's a write off, but you're getting $225,000 one shot and not waiting 30 years. But then yet I have an investor that maybe would pay me, 235. So then we make like a quick $10,000 for the company, or we would pull a whole bunch of them together and then sell them to bigger investors. And that was like the side that I worked for, and his wife owned the mortgage origination business, and just moved back home. My father got sick. Just really didn't like the family business, which was running a pizza place. So I wanted to get back into mortgages. Became a licensed mortgage broker. Was doing great. Then '08 happened. Everybody remembers 2008, right?
Yeah.
So us small independent brokers got pushed to go work for the bigger lenders. And about 4 years ago, I kind of reopened up my broker shop because it was doable for small shops like myself. And then I just got an opportunity to merge with Homefront Mortgage. They're more of a national mortgage broker. Made sense because I still kind of do whatever I need to do, have my own business, and then they generate business for me. And right now I'm working with about a real estate office up in Clark Summit. It's got about 65 realtors, so I just don't really have to be, I would call it bird dogging, all these new realtors that are out there. It's just so competitive because the inventory is just so tight. You guys understand that,
Yeah.
and yeah, so, an independent mortgage broker. So that basically means, we can do everything from QM, which is quality mortgage, to non-QM, commercial loans. Somebody wants to buy a 10 unit. I'm not bound. If I went and worked for like a retail place where they only do uh, like residential mortgages, really is only a 1 to 4 unit. Well, that kind of you know limits your availability. And then trying to work with investors, I need the products that the investors look for. So I mean, obviously everybody's getting more and more familiar with the DSCRs. They're a great product for the fact that if the mortgage covers, if the rent covers the mortgage, and it's at a 1-to-1 ratio, you're going to get decent financing. You don't have to basically do a full doc loan. There's no verification of employment. There's no verification of, like I said, of your income. So your debt to income ratio, you may have like 4 or 5 mortgages on your credit, and you're making $100,000 a year and you have all this debt, things and that, your tax returns are light. Well, guess what? The standard QM investment program, you don't qualify. So these are all these, you know, highly qualified investors that know how to manage money, but we're not qualifying because at some point you max out. So this product was generated to basically say, hey, put down 20%, which is the same as a full doc loan. So it's not like the DSCRs or the non-QM are asking for a larger down payment. You're still putting the same down payment. And it's basically just that one mortgage to that one rent on that one property. And as long as you have the 20% down, you can buy as many properties as you want because it's always looked at in that individual property. So you can really increase your portfolio real quick, because it doesn't matter if your debt to income ratios. I had one investor had 10 properties. He was using too much hard money to get the properties, and he's using his credit cards to fix the properties. So his credit was always going up and down. Long story short,
Yeah.
financed 4 of his properties that had good equity, and that 2 of them were with hard money lenders. About $150,000 in his pocket, and gave them all 30-year mortgages on these properties. These are not short-term mortgages. These are not where it's like a commercial loan. They may balloon every 5 to 7 years. So now the guy's like he's set up. He's got 150 grand. Wants to go buy a property. Now he doesn't have to use his credit card, so his credit scores will get better. So they're really, like I said, they're really good. And typically, like I said, on a purchase, you're going to put down minimum 20%. If you start getting into like maybe the 5 to 7 units and more, you might have to put down 25%. Okay. And the cash out on an investment property with DSCR is at 75%. So, if you got good equity in your investment properties and you're not leveraging it, it's I don't know, like what I mean. It's you have money there that you can help buy you more properties, do other things, other type of investments. So,
So, Lou, real quick on that DSCR loan, it can't be in your personal name, correct? It's got to be in
oh yeah,
LL.
you can do both personal and in LLCs.
Okay, you
Yep.
can. Okay, I
Yeah.
thought different.
Yeah.
I never got one, and I thought it had to be an LLC
No,
or
no. I mean, these investors are coming a little bit more. I mean, technically, you can get away with a 15% down payment now, but the rate adjustment, in my mind, does not make sense because the rate is so much higher. And let's talk about the rates.
yeah,
On average, if you have a good credit score, the stronger the credit score, the better the rate. You might be maybe a half a percent to maybe 3/4 of a percent higher than a standard, full doc loan. But if you're an investor, you understand timing and getting deals done. What the heck do I care if I'm okay? I plan on making, the way I look at it is, and I talk to people about this. Okay, maybe you're looking at a rate, let's just say 7.5, and your profit was going to be say $1,500 a month. Well, if the rate, let's just say it's even 8.5, your profit say is now $1,200 a month. Is that a bad investment? Like, you know what I mean? You're still making a profit. You
sure.
know what I mean? So, and you're able to get the property. and not have to jump through all these hoops, you know?
Yeah.
And then, like I said, I mean, the other non-QM products, we have, you have the fix and flips, where if you're a seasoned investor, you could buy the property, only have to put down 15% of the purchase price, and they'll give you 100% of the renovation costs as long as the, after renovation value is 75% or greater. Okay. So, but let's say you buy a house, whatever, for 100, you put 50 into it, and, the ARV is, 225 or greater. Well, you're going to get, like I said, the 100% of the renovation costs. And,
And what's the interest
and
rate on that?
well, again, they're just interest only options, anywhere from like, 6 months to up to 24 months. You can
Can you
get
get it?
there.
So if I got a,
Another thing too is the rates are always going to be higher in PA, and here's the reason why. Pennsylvania does not allow a prepayment penalty on loans less than, I think, $330,000. So as an investor lender, they have to buy that out. So they really have to jack up the rate because they can't charge you a prepayment penalty. So on
sure.
the fix and flips, those are going to be a higher rate because you're keeping them for a much shorter time. The
What's
DSCR,
what's the average on a fix and flip? I just want to know if there's a difference between you or
uh,
hard money.
I mean, I would probably say on average, it's probably going to start around maybe 9% and go up.
Okay.
So, and, there's always going to be points attached to it,
Sure.
anywhere from 1 to 3 points. But the thing is, you don't have to have the greatest credit score. If you're on a 650 and greater, you're going to get the term. I mean, you're going to get the loan. We can do like I said, we could do these on, 5+ units. It can even be condos. They could be mixed units, so, but again, if you're only keeping it for 6 or 12 months and you're
So,
getting the money,
hey, Lou, let me ask you this, Lou. So, say I was going to do a fix and flip with a few people, right?
okay.
Say there's two guys or even three guys. Whose credit do they take? Can they take just the one person's credit, whoever has the higher credit in the
Well,
company, or
we'll see. Like in other words, it all depends on if you other two people on because you want them to have the same responsibility
mhm.
of it of on their credits. That way, they don't try to let's say everything goes bad, and they're like,
Yeah, but
oh, Mike's the only one on it.
say one's got
They'll take the
500
lowest score. They'll take the low. They'll take the middle score
of the
of the
three people.
lowest borrower. So if you have a 720 and Jake has a 680, they're gonna go off the 680.
Okay,
Okay.
so he's the low
But
mortgage.
then but then also he's also responsible for the mortgage. So that's you put other people on the mortgage that way they just can't walk away if something hits the fan and there's some rough times.
Okay,
So
so what if I had two guys, and one has the lower credit score? Do I not put him on the mortgage then? I just make another agreement, or
well, no, I mean he could be on the let's say the sales contract that you're going to buy the. But if you have the better credit score, I mean, you look at the difference of the rates. If the rates are not that big of a difference, why
yeah.
wouldn't you want your partner to have share the responsibility?
No, without a doubt,
Too?
he's going to share the responsibility. I'm not,
Right.
but I just thought, I don't want the credit score to hurt me.
Yeah, I mean, again, you can look at what the two scores or what the two rates would be, and then you make a financial decision.
And on
But
the
again,
fixed,
if you're only keeping the money for like 12 months, and there's a difference, of, let's say a 0.5%, a 1/4% to the rate, I mean, overall, like, what I mean. That way, the other person as is responsible just as much as you are.
so I borrow the money for I do a 6 month term, and I sell the house in 2 months. There's no, I can't get charged a payment. You said a pre.
Right. There is no prepayment penalty.
Okay.
Whatever, I mean, you can take it up to 6 months. You could do a 12 month. If you pay it
Ooh,
off
real
sooner,
quick,
then you only.
for clarification, does that qualify? Does that stand with non-QM mortgages? The prepayment.
Yeah, these are non-QM. Like a fix and flip is going to fall under a non-QM product. Yes,
Right, but does that? So you're saying you cannot charge a prepayment penalty on a new non?
correct. Right. Just like QM loans now, none of them have prepayment penalties. So the non-QM loans in the state of PA cannot have a prepayment penalty. Like I said, if the loan amount is under 330,000, so if it's under 330,000, you can't be charged a prepay. But they build it into the rate. So somebody, let's say in another state that they can give them a 3-year prepay, and they want it, they're probably going to get a rate that's might be a whole like 1.5% less.
Yeah.
You know what I mean? Because
Just for listeners, I would double check into that because I have multiple loans with prepayment penalties in Pennsylvania right
yeah,
now.
but are they commercial type loans? What kind of properties are they?
They're non-QM. They're commercial. Yeah.
Right, but see, commercial is a totally different set of department than non-QM. You have non-QM loans, and then there's commercial loans. So maybe if you're dealing with banks or other mortgage companies, they might be giving you a commercial product. I mean, they like if your commercial deals, are they like larger loan amounts?
I have one that is like $100,000, and that had a
Is it
prepayment.
with like somebody? Is it with a bank or something? Or
Yeah, that was a commercial loan. So I guess
right.
what is the difference between like a DSCR loan and a commercial loan then?
Well, like I said, DSCR it's considered a non-QM product. So those have their own set of guidelines to where the government says you can't charge PA does not allow a prepayment penalty. But if you have a commercial loan, yeah, that can have a prepayment penalty because it's a different bucket. It's apples and oranges. So the one lender might say it's easier for us to give you a commercial loan because it's easier for them, and they can also charge you a prepay. I have lenders I do commercial deals, and they do have prepayment penalty options if you want it to get a lower rate. But a non-QM product is different than a commercial
Cool.
loan.
I just wanted to I was confused so I just wanted to clarify that. So thank you.
Okay.
I'm really interested. I'm sorry, I didn't mean to interrupt too, but I'm really
Yeah.
interested in what you said at the beginning in the 80s, when interest rates were 20% and you were in the business then, and a lot of people were holding the mortgage. They were doing seller finance. And
Oh, it was great.
yeah, so you were helping people sell those mortgages, basically?
Well, we'd be able to buy all over the country, Hawaii, all is, and like I said, if you had a property and you're holding a note, I mean, you had a note on a house that you sold, yeah, you're able to sell it at a discount. Like I said, and if you were a savvy investor and say, hey, I'd rather have the 225 in my pocket now instead of, let's say $1,500 a month, that $25,000 quote unquote, it's not cash that they're losing, it's just equity. So it's not where they're physically, burning $25,000. It's not like they're paying so they would sit there and say, well, I could make that up and triple this money. Just use the 7-year rule, right?
Right.
You know what I mean? Like it's just so the smart investors that weren't taking the money and going on trips and buying boats and all this stuff. They saw the advantage of it, and it was very cool though, because if you had a similar note, say $250,000 note, and they both had a 24-month payment history, and one had a 620 credit score and the other one had a 720 credit score. Well, just like regular QM loans, the one with the higher credit score got the better deal. So you had to prove mortgage payments. You know what I mean? So just like if it wasn't, obviously a lot of them weren't reported on credit, so they had to prove by like showing canceled checks or showing deposits of the same amount, right around the same time each month that would show the connection.
Yeah.
And then the appraisal was done. So like maybe when they sold it, now the house is worth 300 grand. So now the LTV is down to like maybe just say 70 LTV versus an 80 LTV. Well, it's less risk, so we'd offer more money. And yeah, I mean, it was investors loved them because they were putting them in all their portfolios and stuff. So like I said, the bigger lenders, they would, maybe we put, 5, 7, maybe 8 million together and just sell them, and the investors would take them and put them in their portfolios, and boom.
Yeah, that's awesome. That's
Yeah,
like,
just like
I sound like
when everybody was buying up the subprime loans because the rates are, and then
is that
they're just like give us as much as you can generate.
is that why it was so popular, Lou? Because rates were so high back then?
No, yeah, rates were so high. Plus, it was like you almost had to walk on water to get a mortgage
Right.
back. It was just like everything was just very very hard. But also, and at the same time, rates were in the mid teens. What were CDs paying? You know what I mean? CDs were paying a heck of a lot more, than they are now. But I think everybody realized more people need money to buy houses than have money to invest in CDs. So that's when they kind of, I believe, start making the rates a lot more manageable. So
Yeah, that's really cool. I love talking to people that were in the business back then because they tell me about all this creative real estate they were doing. And like a
yeah,
lot of people think because it took popularity in 2020 to now, like creative finance. And a lot of people think it's new, but like it's not new. It's really
It's not. Look how
yeah.
yeah, it's crazy how they were doing it in the 80s.
Yeah, well that
well, they
was like
had to because people couldn't sell
yeah.
their homes and people couldn't buy their homes.
Yeah, I
Yeah.
think my parents lost their home because they were paying like 17% interest
Sure,
rate, and it just
ridiculous.
they were just walking away from homes back
So I
then.
love it when people complain about rates are at 7.5.
Yeah.
I see that's another thing. See, by being a broker, our rates are lower substantially than retail, and because again, it's just like anything in life, wholesale is always going to have a better deal. We have lower costs, lower rates. And the thing is, I could shop a loan with 15 different lenders that I'm signed up. And you would think like, oh, if this lender has great rates on, let's say, a bank statement loan, they should have great rates on let's say, a conventional with 20% down. It's not always the case.
Yeah.
So you're able to shop around and say, like, this person is buying a $600,000 house with 20% down. Lender B is giving me the best rate. And I just did a bank statement loan with a contractor, 12 months of bank statements, literally tripled his income from his tax returns. He's got good credit, and they're cashing out 75% of the house. They got a nice house, got tons of equity in it, and they want to consolidate some debt because they're kind of getting a little out of control with their credit cards because the cost of living is going up.
Yeah.
So we're going to blow off all their credit card debt. They're taking a lump sum and now paying cash for an investment property they want to buy. So now they're using their equity multiple ways and literally freeing up some cash. And now that all that credit card debt is tax deductible because it's in a mortgage, you
Yeah.
know. And
That's
that rate, like I said, with the other lender, it was so much lower than my other lender that does really good with like what I said with like QM loans. So that's the advantage of when you work for a broker, is we can shop around. Is where if you go to a, the
A bank.
depository bank
Yeah.
or even a retail lender, like Guaranteed Rate or Cross Country Mortgage, they have one set of rate sheets, and that's what they can offer you. And they can't do things that we can do.
yeah.
We can buy out underwriter fees. We can, do all these crazy little things that make the deal work. We can waive escrows to lower your cash need to close on conventional, but less than 20% down is where other lenders will require you to escrow. So if somebody's got tight funds, we can just, like I said, waive it, and now they can buy the house. So.
Yeah. I think what's really awesome about like calling you, Lou, over someone else is first of all, you have more experience than most people in the country, probably. For you've been doing it a while. And also, so not only are you licensed, not only can you get that conventional product and figure out what's right for the customer, but you can also go into the non-QM world too. Because there's a lot of people that are brokering non-QM stuff with no license. What do you think about that stuff? So we had another guest on that.
Well, yeah, like technically, see, I'm licensed in PA, so I can really only do, QM loans in PA. But certain states will allow you to do non-QM and commercial in other states and not have to be individually licensed in that state. See, the thing is, I'm licensed both nationally with the NMLS, so you could basically take my license, number and put it in the database, and it's going to give you my entire history. And if there's any negative reports, even when I was a broker back in 1999, that's how far it goes back. Though everything, your entire record is there.
Yeah.
These other people that quote unquote are now saying that they're lenders, and we all know who that is. They're not licensed at all. So I don't know. Would you want to deal with somebody who's not licensed and can't check their credentials, or somebody who's licensed and you can check their credentials? Now, again, like I said, I can, do a loan, let's say in Delaware, but I don't need to be licensed in the state of Delaware because I'm nationally licensed with an NMLS number, which is the national database. It's just like anything, a contractor. Would you hire a contractor who's not properly licensed? Like, you know what I mean? It's just, you get for what you, I don't know, like for me, like, I don't know.
No, everybody I have now is a license. But when I first started, if you could hit a nail.
Well, financial advisor, you can use somebody who's certified or somebody who's not certified.
Yeah, well, now building new construction you got to be certified, but
right.
But no, Lou's actually really good. You've met a few people at our real estate meetups.
Yeah, I did a few transactions for a couple of people.
I know a broker that likes you. There's a few realtors that like you, and Jake. It's crazy because he's not like the regular guy. I call him all the time, Lou. Right? I don't buy anything from him yet. I have to.
But see, like you already have products, and I can't do any better as of right now for the products that you need, which is driving me nuts. It's like, what's so funny is, like, I call it the unicorn in our business. There is no new construction wholesale lending for manufacturing and modular builders. That's why you guys go to the hard money guys, because it's eventually, I think it will happen, because
it will. And I've talked to a few other guys like yourself, who I'm probably.
It's like unicorn. It doesn't exist. It's like
same thing. I'm telling you, something's coming up in the next 12 to 24 months. It has to, because that's where all the big builders now are going that way.
Like I had I had a new construction down in Bucks County, down by Philly, because I got, that realtor I'm working with a little bit. And unfortunately, like, the loan amount went over the maximum conventional. What's that?
How much is that for? How?
I think the max for 2025 is around 800 and it's like 840,000 or something. Long story short, the construction part of it was going to be like well over 900 grand. So I'm like, great, no problem. I have lenders that do jumbo purchase and refis. All right, no big deal. So I'm trying to price this, and I'm like, I'm not getting any pricing. And that's like the unicorn. There is no new construction jumbo lenders out there in the wholesale market. That's where you have to go to, like, a depository bank. Yet, they're not going to give you the greatest terms, but they can do it. And like I said, same thing I feel with the new construction for manufacturing and the modular homes, especially manufacturing, because I've been seeing articles and articles. We all know the cost of building is crazy.
Yeah. So we had that discussion about manufactured homes, and just people understand some people don't know what a manufactured home is, but it's a mobile home.
Yeah, but today's mobile home isn't like yesterday's mobile home.
So after we had that talk, I went to a manufacturer and they were showing me mobile homes.
They have triple wides now.
Yeah, I was in a triple wide. I was in a triple wide
stories
with vaulted ceilings.
Yes,
it was crazy.
Yes, yeah. And when FHA starts saying, "Hey, this is probably the last true affordable housing in this country," and they're backing it more and more, that's where I feel the lenders on the wholesale market will kick in and maybe start working with investors. So,
and just so you know, in those manufactured homes, Lou, because we had an hour discussion, me and Lou, about a week ago about this. But besides panelized, boards inside instead of drywall, they actually do a contractor's pack where you could have drywall in the, it's drywall. It's completely. It looks like you're in a modular home. It looks like you're in any home.
Yeah, It's the parts of the country where, like, down, I think it was like maybe South Carolina, North Carolina, is where before, like, if you try to get zoning for manufacturing housing, they're like, no. Now there's areas that will always say no, are saying yes because they need housing. And these are nice houses. These are nice. You're gonna like here's what's going on. People are paying $200,000 for a property in Scranton that hasn't been renovated in 100 years
Yeah.
because they can afford the payment. So they're paying for these houses that need total, not just updating, need bones, need new wiring, new plumbing, new heating, all these things.
They'll
Well,
never be energy efficient, nothing,
no,
right? To just why even
right.
put the money into it?
And they're showing like some really nice, like quote unquote, double wide and triple wide with all these open floor plans, you know, state of the art stuff, nice vaulted ceilings. And they're saying on average, now obviously not putting a foundation in, you're putting on, pillars and posts, which is still a permanent foundation. But they're saying like, probably around 250 you can get into a new home
Yeah, so
with a
but
nice piece of land.
that's about
But that's
it.
another
But
thing too. You're getting land.
yeah, if you
Like,
if you you know, that's not a bad gig if you can buy land. I don't wanna say on air what they really cost, but
right.
they're a
No, but
little
I'm just saying,
pricey.
this is the article was saying down there, they're saying the average new construction home is over 400 grand in North
Yeah, the
Carolina.
average
Well, they're saying the
the
average
price is I think
manufacturing house,
425, right? Am I right, Jake? The
Yeah, the
average
gate is over 425,000. Yeah,
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 that's crazy.
right,
yeah.
right. And that's just a what? A plain Jane new construction house.
Nah, we could do nice for 425.
It's a nice, but
Well,
it's
but,
not a mansion, that's for sure.
No, it's not a mansion, we're talking ranch, maybe with a
right,
crawl space and a garage.
Yeah,
right.
yeah,
Yeah, it's just like I said, I mean, it's just crazy times, but yeah, I mean, and then like I said, some of the other products that we have that are non-QM is, we do have bridge loans, where, we can do those.
So bridge loan, so like if, I got a fix and flip loan and where I was gonna do 6 months and I had to continue it or
No, a bridge loan would be like if you had a property A and you wanted to buy property B,
Mm,
you could do a bridge loan on property A to get property B. Helps you kind of like,
yeah,
basically it's a bridge, and you don't really pay anything on a bridge loan until the end. So you don't make any
gotcha.
payments on the bridge loan. So you're not getting stuck making, let's say, two mortgage payments. Now ground up construction, we got investors all over the map for non QM. And it's so funny because it drives me nuts. I'm like, why? Like, oh, yeah, ground up construction, no problem. We'll give you a great finance. But okay, well, but modular manufacturing,
But
I've talked to
yeah,
a good half dozen wholesalers and it's the same story.
I
yeah.
ask Lou all the time, "Help out, Lou."
So,
Yeah. I borrow
yeah,
private money then, it's okay. That's only for my specs. For a customer, it's fine.
right. Right.
I'm not
Well,
worried.
yeah. See, like if a customer, let's say, you're building a home modular, and the customer is the end buyer. Well, he's the one that's getting the mortgage. I can do those all day long. I could do construction loans all day long. Conventional with only 5% down. That's most lenders start at 10 and go up.
Yeah, but are you
I
gonna
can
be
do
able to get me
VA.
are you gonna be able to get one for my modular person?
Yeah, if they're buying the house and the land off you, they're the ones that are applying for the mortgage,
Yes.
right?
So they buy
Yeah,
the
so
land.
that's the end buyer. I can do those mortgages all day long. I could do FHA new construction. I could do VA new construction. Now the thing with the VA new construction, the
Yes, I
builder
have to
has
be
to
I
be
have to be
certified
certified.
by the VA.
Oh wow, I didn't know that.
Yeah.
What's that?
I didn't
I
know that.
Yeah,
That's a
it's a simple step, but it's
it's
like
not
something you
hard, I
want to
know.
check out up front
Yeah.
to make sure, like, if you're going to do VA new construction, you are a VA builder.
Yeah.
It's a little application. That's really all it is.
So
Uh,
yeah, but for, like I said, for the end user, I do mortgages, new construction all day long.
so what's
It's the
what's
investors that are having the problem.
yeah, as the investor, yes. But what's the best for I have a
So,
customer now,
but
they're gonna buy the land cash and then they're gonna go get a loan. Should they just lump that all into one?
well, here's how. Why wouldn't you want the customer to take out the loan? That way, you're not tying up your cash.
Yeah, well,
You're
no,
going
I'm
to
not.
create
They
the draw. You're going to create the draw schedule,
yes.
right? So, and they're the ones that are going to be making the interest only payments during the construction phase. And another thing too is most of my products is a one time close. So if the borrower gets approved in the beginning and it takes 10 months to build, they don't have to get reapproved and reapply. They don't have to repull their credit.
Oh, that's
That's the
nice.
advantage of one-time close. And if the rates drop during that construction to end phase, they're able to drop their rate.
But if it goes up, it stays where they're at.
Correct. Yeah. Yep.
That's
Yeah.
good
Most one-time close, they give you 12 months
to
to basically complete the project, 11 months to build it, and the last month you need to convert it over to a mortgage. You got to get what's it called, the E and O or something, and the
I might
occupancy
have
permit.
somebody for you.
And yeah, I mean,
Where do
so
you see rates going, Lou? Like if somebody's sitting there waiting
it's
to buy.
crazy right now. I mean,
And don't say
if I
1980.
had, I mean, yeah, if I predict that, I'd be on Wall Street. But I mean, I just tell people like you date the rate. If you get a great deal on a house and if your strategy is I'll wait till rates drop, it's not a good
Forget it.
business strategy. If you can get the deal of the house that you want now, and you can always refinance it if it makes sense. Now, where another thing to do is you can buy down the rate. If it's an investment that will guarantee you a return on your investment. If you buy down the rate, let's just say you buy it down from say 7.5 down to let's just say 7. It's a size, good loan amount. You see a difference in the mortgage payment, and let's just say it costs you 1 point, and the loan amount. Let's say it costs you $3,000. The loan amount is 300 grand. Well, you divide what the payment savings into that 3 grand. That'll show you like how many months you're going to take to break even, and then going forward, then you really truly are saving that kind of money. So I think on average, like if you can recoup your money in around 2 years or less, it may make sense because if you refinance it before you recoup all your money, you actually lost money.
Sure.
But again, that's always an option. You can drop down the rate because let's just say
Yeah.
you drop it down to say 6.5, right? Even when rates start lowering, it may take you a year or two before they get to 6.5. So if the rates drop down to 6.5, you're already been there for the last say year and a half.
Yeah. So Lou,
You
if
know,
I'm a seller, if I'm like a developer or if I'm flipping houses, how do I buy down someone else's rate? And how much does that cost usually?
well, you can do what's called like it's a 3-2-1 or a 2-1 buy down, and it's called a seller credit. So let's just say it's $100,000 house, and they ask for 6% from you. Well, that's a $6,000 seller credit. They could take a portion of that and buy it down. So let's just say it's a 2-1 buy down, and the par rate right now is 7.5. Well, the first year, it's like I said, it's going to be 6.5 for the first year, and then it goes down to let's say 7.5, 7.5 like that after the second year. If you do like a 3-2-1, whatever the rate is, let's say 7.5, the first year is actually going to be like 3%, like it's going to be actually 3% less. And then every year it goes a point until it hits the par rate they initially did it for, and so you could do something like that. You could do like take a portion of the seller credit and buy down the rate. But it all see if it's a low loan amount, they need that money to actually pay their closing costs than to buy the rate down. You know what I mean?
Yeah.
So,
And there's a lot of product out there
but
for
yeah, you could do a buy down on the rate.
and you always should have a lot of product for your first
You
time home
know,
buyers where they could actually get money back, you were telling me at one point, no?
well, I mean, on a VA, technically, you literally can get when you get a seller credit, you're literally getting your deposit money back and things like that. Uh, Now, again, what we no, what you might be talking about buying a rate, like in other words, I call lender credits. Is that what you're referring to?
No, I don't know. I remember
Where like
we were talking about my son, and you said, "Hey, there was a program at the time where he said, actually, Mike, he would actually be getting money back."
yeah, I don't recall that,
It's
but
okay, Lou. I ask you so many questions. I
no,
put
that's
him on the
okay. But what
spot.
I'm saying is like we can, as a broker, we can do what's called lender credits. If we can raise your rate and give you more money back to help you with the closing costs. Because if you're short, let's say 2 grand, and you can't buy the house because you're short 2 grand, and they just can't come up with it, even with a seller credit. Well, I could take the rate, let's say at par would be at 7.5. Hey, listen, I raised you to 8%, the payment goes up, let's just say it goes up less than $100 a month, but you're going to get $2,500 back in lender credit. So it accomplishes you to get into the house. And in my eyes, you know, if the payment's $100 more than initially that we thought, then maybe you weren't comfortable with the original payment too, because it's a mortgage. You know what I mean? If it goes from 1,000 to 1,100 mortgage payment, you know what I mean? It's like I just feel that you weren't really comfortable with $1,000 mortgage payment.
Yeah.
But yet, this is a way for you to get into the house because we could just raise your rate and give you lender
'Cause I'm not
credits.
losing a house that I thought I liked for $100.
Yeah.
Right. That's just it. Right. Exactly. And then not only that, though, it being so competitive right now, where if you ask for a seller credit, even 2 or 3%, you might lose that house because somebody else with the same offer, conventional, 20% down or conventional, not asking for a seller credit. I mean, most people are going to go towards the deal where the buyer's not asking for a seller credit. Where I can sit there and say, hey, you're a couple grand short. You do have funds, but you're a couple grand short. We don't, the realtor's saying it's best and final offer. We got five offers on in 24 hours. I'll say, listen, here's what I can do. I'll just raise the rate to cover what we would ask the seller for. And or a combination of not having the escrow for conventional and not have to worry about setting up an escrow account. So that combination of not setting up an escrow account and buying up the rate could give you that difference of what you would need from a seller credit.
Yeah.
So that's where credit financing comes in,
Yeah. That's helpful.
And then, like I said, with investors too, like these DSCRs, they don't need to be seasoned investors. You know what I mean? So we know a lot of times those investment loans with the bank, they want experience, right? And then you're trying to start out, and they're really making you jump through all these hoops. The fix and flips, like I said, we can do them for non-experienced investors. Who's going to have to put down more money, and then like I said, the ARV is going to have to be a little bit higher. You know what I mean? So.
What type of experience do you look for like a new construction loan? What will you do there?
Well, the new construction loan, if you're talking about you taking out the end, so you're hiring builder A to build your house, and you want a mortgage, right? A new construction loan.
Yep.
Right.
Are you gonna sell it? Are you
So the builder themselves are gonna have to,
Jake, are you doing it to spec a
the
house out?
builder's gonna have to, meet certain qualifications.
If I was doing
I'm sorry, what was that?
if I was doing it to sell it, what type of experience would you want to see?
That you have done them in the past, like whether they're fix or flips or renovation loans, you're going to have to show that scope of that prop. Let's say now all of a sudden it's a $300,000 project, and the biggest project you ever did was 50 grand or 100 grand. They may have a problem with that because you're really jumping up. So what they're going to do is they may require you to put more money into it, and then or lower, like I said, and lower what they would give you. But they're you're going to have some experience. Now if you're doing new construction,
But what if you teamed up with a guy that had experience? Then you're going to use.
then they'll just go off with that. Yeah, they'll use that person.
Yeah. So
It's
say
whoever. Yeah, it's like
I do new construction, so I have enough construction where I team up with a guy
Yeah.
like Jake, and then it's not a big deal.
Jake doesn't need to be as qualified as you because you as a team are qualified.
Yeah.
So
Okay.
Are you seeing more new construction loans lately, or are you?
No, because the average person can't afford them. Like in other words, like you said, 425,000. Well, that still comes with a hefty mortgage payment, and even if you have two people working with a good income coming in, you're still, and then you have your normal debt. A lot of people, the average person can't afford new construction because just the cost of it. That's why they're overpaying on a house that's only worth about 160, Now they're willing to pay one like 200 because they can afford the payment.
Yeah.
You know what I mean?
Yeah, that's
Versus, okay, if I'm paying $1,800 a month in rent, I could buy this house, you know what I mean, and have a yard or something and not have a neighbor or like I'm living upstairs or living downstairs or whatever. So the average person, new construction, I don't see a lot of it. There's developments, I live in the valley and there's a development next town over and the lots are starting to sell, but they're slow. Now the townhomes that were around 350, right? Real nice townhomes, they're all gone. 2-car garage with 2 bedrooms, 2 bath townhomes, nice ones, 9-foot ceilings. They sold because they're only at 350.
Yeah.
So that's why, like I said, I mean, I keep beating the dead horse though, but that's where I just manufactured housing is going to be coming more and more because, like I said, FHA is really starting to back it, and I'm reading article after article saying, yeah, everybody wants the $600,000-700,000 house, but they can't afford it.
Yeah.
Yeah. But there's people out there that could afford it. I know because I get
Yeah,
the calls.
right. Right, you get the calls, but that's your market.
Yeah,
You
yes,
know what
yeah,
I mean? But
yes.
that's the market that you're gearing towards, you're marketing towards. Those are people that are coming from the city, New Jersey. To them,
No, they're coming
$700,000,
everywhere. Yeah,
$800,000
yeah.
is nothing. But if you come from this area, and you grow up in this area, you got a good job, but not a fantastic job, you're not gonna be able to afford it. And
I
a
just
$400,000,
yeah.
$500,000 house.
No, but I just had a reality
It'll
check with a
it'll
customer
be
now,
scrap.
They don't realize
I
what things
mean,
cost.
the next shoe that's dropping is the student loans.
Yeah.
You know what I mean?
Or
Like
pans.
they're starting to, huh?
No, someone dropped pans. I said, "Oh, the pans are dropping." Was that you, Jake?
But yeah, the student loans. I mean, times I look at people and it's like, it's
Yeah,
like
student
I
loans.
had one girl. It's $155,000 student loans. I still had to use 0.5% of her payment of the student loans because they were deferred. That's $760 just on the student loans, and she was making less than $4,000 a month, and she's looking to buy a $250,000 house.
Yeah.
Realtor's like, "What can you do for me?" It's like nothing. I'm not a magician. Like I'm not a magician here. Like what? Like yeah. Does she have like? I mean, I give her a loan for $100,000. So does she have $150,000 laying around to buy the house?
Yeah,
No. And then the problem with that is with the values going up. If somebody's approved for FHA and they're approved for 150, good luck trying to find a house that's going to pass FHA. Because where before in the past, when things were normal, you could buy a $150,000 house and it passed FHA all day long. Now these $200,000 houses are having issues, because the values have gone up so much, and they're not passing FHA appraisals. They're coming
because
back with all these.
because like we said, $200,000 really buys you a junky house.
Correct. Because where before, when things were normal, you had a decent house. You're able to live in the valley where I live and have a nice house. That same $200 house now or back then is probably going for like close to $375.
Yeah.
Well, you have to buy the house at $20,000 to put $100,000 into it to sell it for 200, basically.
Right. Yeah.
So,
Yeah, but who's doing that besides you,
no,
myself,
that's
or
what I'm
others?
saying. Yeah, most people are, they're buying houses, they're overpaying on the front end, and then they're not able to do good enough work because they overpaid at the beginning, and then they're selling a shit product on the back end,
And
but
it's
it's
not.
still affordable. Yeah. So that's where we're in.
Yeah. I mean, I had some guy did a fix and flip up in Carbondale, the whole lipstick on a pig thing. And
Yeah.
great, that's why the appraisal, they're done. And they didn't properly winterize the house. So the appraiser went in, some pipe busted with the steam, like all those block ceilings. And
Yeah.
like all upstairs were all on the ground.
Yeah.
Because they didn't properly, they didn't do what they were supposed to do. And the buyer backed out, and the seller's like, you're the investor. You didn't really do anything to the house. you didn't properly winterize it. You didn't, you know what I mean? And good thing, it was. I'm looking at the pictures. I'm like, all the ceiling panels are on the floor up in all the bedrooms upstairs. So,
Are you seeing the student loan
yeah, I
thing
mean,
like hurt a lot of people, prevent them from getting loans? Are you seeing the student loans hurt people?
yes.
Yeah, yeah, that's
Well,
crazy.
it's hurting your buying power. Yes. Like if you're making just average income and you're not making, see, what I'm starting to get is I'm starting to get people from New York and New Jersey that are making great bank and their employer is able to let them work remotely. I have two closings this month and they're both working, quote unquote, in the city of New York, making for New York, not for New York, average money out here, way above average money. So they'll be able to buy up in the Poconos, buy up in Mount Cobb, and get like a nice piece of land, nice house, and just work remotely. Maybe go to the office once or twice a month, and that's the type of buyers that can afford those houses. If I'm getting somebody that has got an average job around here, they can't afford those houses, especially if they have student loan debt. Because, like I said, the rule is if there's no payment attached, you can't use income-based payments anymore. Like someone got a $150,000 loan, student loans, and they did an income-based payment of $72 a month. Like, you know what I mean? Like but before you're able to use that, but now you can't because it's just there was way too many defaults and everything. So you have to use a minimum of a 0.5% if there's no payment that's being registered on the credit report. If the credit report has a payment registered, it's based upon it, being amortized out. So you're able to use that payment if it's on the credit report.
Okay.
But or a 0.5%. Like FHA will allow you use a 0.5%, and Freddie Mac will allow you to use a 0.5% of the balance. Is where Fannie requires you to use 1%.
So what if, like, say one of my sons, right? I co-sign his school loan, right? He's
Right.
paying it back now. Does me being a co-signer affect any of his buying power or how much money you can?
Well, yeah, because you still got to get hit for that payment.
So he's still
The
responsible
only
for
way,
that payment
yeah,
no
like
matter what.
like
So
I just had an attorney, and I had an attorney out in New Jersey buy a vacation home out here, and debt to income ratio was a little bit high, and went over all his debts. That's why he review everything with a client, and he's like, "Oh yeah, my two daughters are making those two student loan payments." So he co-signed for them. So I said, "Okay, then all I need is 12 months proof of showing your daughter's making those payments, and the underwriter can back those two payments out, and they added up. They were a lot together. They're a large monthly payment if you combine them. So once we proved it, then we were able to back it out, and it lowered his debt to income ratio, below
yeah,
where they needed to be.
because that just affected me on something. Getting a car. I mean, I still got the car, but
The
say
only
like
way you can prove, yeah. See, car financing is different than
they
mortgages,
said, hey,
but yeah,
your debt to ratio is a little crazy. You have 250,000 in school loans.
right.
And I'm like, what? I honestly, I don't even know what I co-sign anymore. You know what I mean? It's for my kids. I'm like, yeah, there we go. Right.
Now, here's what you're going to want to do. Let's say if you are, if your kids do plan on paying back their student loans,
Yeah, be
right?
great.
Always have them pay out of their account.
I
That way,
do.
if you need to remove that debt for whatever reason, then
Yeah.
you have, as long as you can show 12 months of payment history on those student loan debts. When it comes to a mortgage, they'll be able to back them out. But see, again, here's where a non-QM loan like a DSCR or, like I said, like a fix or flip,
It won't matter.
your ratios are irrelevant.
Yeah.
You know what I
Right.
mean?
So it's really just my credit score, right?
Yeah,
And doesn't matter if I have a job. You just care about that property.
right,
But
exactly.
you're not supposed to be living there, right, Lou? If you're
No,
doing
you
it.
can't live
Yeah,
there.
you can't live. Yeah, non-QM, DSCRs, you can't live there.
Yeah.
And some lenders, you have to look at their guidelines. Some actually want you to own a property.
Right.
Also,
Right,
I have a couple investors. These two ladies out in New York. It's cheap for them to rent an apartment than own a house.
Sure.
and they got good jobs, so they're all out here buying investment properties, about two a year on average, uh, and just have to document like the landlord wants to get paid cash, so we couldn't really show the one person paying the rent. So we literally just had to do like quote unquote like a rent free letter. The one investor said, "Hey, just give us a rent free letter. We know she's been there for 7 years," and they were able to do the still do the loan. So you got to check the guidelines. So technically, if you don't own a house, let's say in Lackawanna County, and you're looking to buy a house even in Luzerne County or 2 counties over, they may have a problem because it might be a way for you to get around trying to get qualified for QM, because you might not get qualified for QM.
Mm-hmm.
Because with a non-QM, all you really need is the down payment and a marginal credit score.
Yeah.
So,
Lou, I like that you could you figure things out. That's what's really good about you. From when I go to my regular bank, and I don't want to say the bank's name, like you said earlier, it's A, B, and C. If you don't comply to any of those, I can't give you a loan. With you,
yeah, well,
you
it's because I mean,
you have so many different options. You sit and explain. I know you helped out realtor friends of mine, a lot of people, which is great. And I really, any investor out there listening, if you're looking for that DSCR loan or fix and flip loan, you should definitely reach out to Lou. He don't charge you to talk. I hope not.
right?
Right?
No,
Only 2 points on the weekend. But
yeah,
no, I
right.
mean, I know a lot of people that are happy with you. And I'm going to be happy when you could help me in the modular world. But until then, we'll just be friends. But yeah,
Yeah, like I
I'm
said, just
just,
bring
I really like how you
bring
can
me
help a
the
lot of people.
buyer.
You were a
Yeah, like I
guest
said, look,
speaker, and
if someone wants you to build a house for them, let them take out the mortgage and have them come to me.
yeah, well, I'm
You
going to have
know,
to, I listen in some of my fix and flips. I put those little flyers you made for me, you know, but I never even thought about buying down people's rates. I like that Jake was talking about.
Yeah. Well, that's
Yeah.
a lot of the big builders are doing that. They're buying down people's rates down in
Yeah.
Florida. So it definitely
yeah,
helps.
but well, yeah, if you're dealing with $600,000-700,000, you're able to have the rate 2 or 3% lower for the first couple of years.
Yeah.
You know what I mean? It's
Sure, that
yeah,
helps.
and make it exactly. And then your plan is okay in 2 or 3 years. I'm more into my career. I should be making money. And when rates go up, rates come down. These rates are average. These are not unusual high rates but everybody got used to the super low rates. On average, that's what they are. They're about average.
So,
You
What
so
know,
you're not one of those guys that's like rates are definitely going down then.
they will go down, but when nobody really knows. I mean, yeah, they'll go down probably a little bit, but they're going to go down slow. They're not going to go down a full point after the Fed low. Let's say the Fed lowers the rate.
and they
The
didn't say,
max that
right?
they
They
would
just
probably lower it is maybe a 0.5%. Another thing too is you don't like when the Fed lowers the rate. It's not a ripple effect where rates across the board go down a 0.5%. It's however the market reacts to it, and it's more like what that 10-year Treasury bond reacts to it. In times when rates go down, quote unquote, from the Fed, on the real world, they actually go up for a while.
Yeah. The 10 year
It's
goes up.
not, they're down a 0.5%. So now I'm like, 7. I was at 6 or 7.5. Now it doesn't work like that. But even if they come down, like if people think they're going to go into the low sixes and high fives, that's going to be years. It's not going to happen in 6 months. It's not going to happen in a year. Like it's going to go from 7.5 to 6 in a year.
So
So
have you been tracking
buy the
the
property, huh?
have you been tracking the Treasury market? Have you been watching it at all?
Well, I get alerts. I'm just too busy trying to get deals done where I don't really get it. I get alerts when rates have improved or rates have decreased. I get alerts and everything. Sometimes rates get suspended, but I mean I don't know how you guys are, but like now is a great time where like if rates are too high for let's say that end buyer, just hold the paper, and then when rates go down low enough, just sell it to them. I mean, you guys know how to fix. Like you guys have your crews. You know what I mean? Like if so it's like maybe I can hold it, let the house appreciate more and more, and hold the paper and sell it if you
Yeah,
want.
Yeah.
You
yeah.
know what I mean?
Well, so I before we end here, I'd want to go back to the beginning, like, because that is really cool. Did Dodd Frank kill that too, where you were able to like generate a mortgage and then sell the mortgage? Did Dodd Frank have anything to do with that going
Dodd
out?
Frank actually did a lot of good things in my eyes for the fact that it put more checks and balances in place that should have been in place. Everything that's quote unquote in place now was always in place. It was just never enforced. Okay. So the whole 3 days CD before the closing date, you have to have your final figure minimum of 3 days before you actually close. That way you're not going the day of the closing and be like, wait a minute, I thought I needed 10 grand. Now I need 12 grand. And now, like, you're able to, like, there's a lot of unethical things. So you're able to increase your fees at the end and be like, it is what it is.
Right.
The Dodd Frank, the whole thing about the appraisal, where it's got to be third party. You don't know who the appraiser is. You just order it. So it put a lot of the, bad things, got a lot of bad brokers and bad lenders and stuff like that. Uh, So I embraced it because I always did everything the right way. And then you had to get licensed. That was funny because it was quick stories. Like when we first started about this license, somebody from the Department of Banking came and he goes, listen, it's probably going to be easier for you to have, let's say, a felony manslaughter charge and get approved as a mortgage and get a mortgage license than if you have any type of felony fraud, like any type of financial felony. Like it was like trying to give us like all these people that are quote unquote mortgage brokers now,
Yeah.
because all you had to do was send $1,000, fill out the paperwork, and you were a licensed loan officer.
So
That's
I
all it was.
did.
Yeah.
It was 500. It was
What happened?
500, and I was 500, and I had to
Right, for
take.
the first and 500 for the second.
Yeah,
Yeah,
and I had to
thousand
take.
dollars.
They gave me a test. I think it was like 10 questions. They mailed to me, and I filled it out and sent it back.
That's crazy.
Yeah, that's it. Yeah.
And I was a
So
mortgage broker.
especially in PA, Florida was always real hard to begin with. You had to do what is required now nationally. But yeah, in PA, so there was people like that were crying and crying. I'm like, yeah, because you're like when they do your criminal background check, it's all going to come to light, And a lot of people just got pushed out of the business. So Dodd Frank, I think it did a lot of good things,
Yeah.
you know. So
And is that when you started seeing the non QM stuff come online? Is when after Dodd Frank, like some of this non QM opened
well,
up?
not really only started really picking up pace, I would say, in the last 12 months because it was just so hard for people to get qualified. And I think the investors realized there's a lot of money out there with investors that want to buy real estate that have the assets, but they're light on the income. Okay. So somebody with a 750 credit score and a 10 property portfolio is a much lower risk than somebody who's an FHA buyer buying their first house and everything's being gifted to them. So, but these people could no longer go to the bank because they're saying your debt to income ratio with these mortgages and what you're showing is 100% or it's 60%. You can't get qualified.
Sure, and
So
you can only have so many FHA loans, correct?
we can only have one FHA loan. It's
I
got to
mean,
be on your primary.
yeah. What's the other
So,
one?
but what I'm saying, like if you're doing a investment property and an investment mortgage, it was a full doc loan, which means you had to verify income every single time, and you had to verify all your debt. So if you had, $4,000 a month in total monthly bills on your credit report, that's was $4,000 plus. Let's say now you have another $1,500 estimated PITI. Now you're at $5,500 a month debt, and yeah, we're verifying $8,000 a month in income.
Yeah.
Well, your debt to income ratios, doesn't qualify.
No, shot.
So they just really opened up the investors and the lenders realized there's such a huge niche. And if anything, it helped the economy big time because if you're investors, what are you doing? You're buying properties, you're fixing properties. It was way too stagnant because these people were highly qualified but couldn't get the loans. So they only really picked up, I would say maybe like in the last 12 months. They may have been around a little bit longer, but I know like I was doing a lot of them when they just first came out. Not a lot, but I was doing a lot of them, or I was doing them when they first came out. Now it seems like every mortgage lender, all these other people, they do them now because
Yeah, I see them
it's
all
the
over the
popular
place
thing to
now.
do. And
Yeah.
And
yeah,
where does all this money
they're all
come
quote
from?
unquote expert. Like I said, I was doing them a year ago.
Where's all the money coming
What's
from?
that?
Where does the money
The
come
lenders, man. I mean, I don't have direct, huh? I have no direct. I don't know personally, but you got tons of lenders out there, so they're build. There's investors out there left and right.
Yeah, there's
You
tons of
know,
money
I
looking for
mean,
places to go.
So
Yeah,
I guess a lot of these
yeah,
DSCR loans are not faulting.
yeah.
If banks are everyone's trying to start doing them, hey, you know what? I'm actually
No, because
because I'm selling these to
yeah, even if a little
seasoned
bit,
guys,
yeah, even if it's
and
defaulted.
I
I'm
know
sorry,
the
guys.
number, and the house is already cash flowing. So I'm going to give you the money,
Correct. Yeah.
but they have to
Right.
live in
Yeah.
there, correct?
Versus your
It's got to
first
be
time
fully
home buyer.
rented, right? On a DSCR loan, it has to be
Not
fully
necessarily.
rented.
No, no.
No,
If they're not rented, then the appraiser will say, okay, this unit A is $1,500 a month. Unit B is $1,400 a month. So therefore, your total gross rent are $2,900 a month. They don't
okay,
need to be rented out.
okay.
You know.
So yeah, I
So
understood that.
yeah.
awesome. Well, how do people get a hold of you, Lou, if they want to get a loan or if they want to ask you a question? What's the best way to get a hold
Yeah.
of you?
Phone number is thank you. Phone number is 570-702-1385. Email is lourose@homefrontloans.com.
Awesome. And all of his info will be in the bottom in the description. We'll be able to find that down here below.
Yeah, whether you're an investor, a realtor, just need to get a loan, give Lou a call. He'll really work with you. I mean, I've only, all my friends only say good things about him. So,
Yeah, there's a lot of realtors listening to this. Anybody that really needs help with their client, like Lou's
And
the
that's
guy.
Lou,
another thing too. Like,
Lou's very good at helping out realtors and their clients.
Yeah.
They call him at the seventh inning
and I,
stretch all the time.
yeah, I'm not going to tell you how it is. Sometimes it's not what people want to hear, but
But you're
correct.
getting some of these
Yeah, I
people
mean,
closed that other banks couldn't help. Correct?
what's that? You kind of froze up there.
We're
Yeah,
lagging out now at the end here. So,
yeah. I think someone's telling us, hey, that's it.
oh,
Oh, Lou.
that was perfect.
Perfect. So anyway, anybody wants to get a loan, you're a real estate investor, you're a realtor, call Lou. And
Yes,
here he's back. He
I
wants to
just
say,
lost you both for a few seconds there.
you're back. You're good. It was perfect timing.
yeah,
All right.
we were just saying great things about you.
So,
Um, once again, if you need a loan, call Lou.
all
Whether
right.
you're a realtor, an investor, you're looking to do a fix and flip, you need a DSCR loan, you have a client that needs a little extra attention, Lou is here for you. I'm sorry, I have no voice, so I'm gonna stop now. Jake, any last things you
All
have to
right.
say?
No, thank you so
I
much, Lou.
appreciate it, guys.
Appreciate it.
All right, you guys have a good evening.
All
Thanks.
right. So Lou,
See ya.
we're
Yep.
we're gonna say goodbye. Goodbye, everybody. Thank you.
Oh,
And
we're
you
gonna take a